Okay, good morning, everyone in British Columbia. Afternoon in Toronto, and good evening. Saw a couple people from Europe calling in, so that's awesome. Okay, title of today's talk is 2023 Recession All But Certain, How to Profit in the next year given this news. Now we're going to talk about what's going on, and last time we spoke was in June. The markets were down about 22 or 3%, and here we are, September. I tend to do these calls when I get a lot of calls, a lot of worry calls, and I say, oh, it's time for a call. I think one of the best indicators we've ever had is when the LePoidevin Group does a call just by stock market. Think about, man, have we been through Trump, trade wars, then it was the pandemic, and now we got the greatest and most rapid increases in interest rates that we have seen in generations. So let's get right into where we want to go. So why is there so much talk in the media about this upcoming recession? Well, it stems back to what we talked about a few years ago in the pandemic. And in the pandemic, they were printing money because the pandemic itself was a deflationary phenomenon. When you get people just working from home and not working, and the economic output collapse. So that would be akin to the Great Depression. So the root cause of inflation is money printing. So we printed money and started mailing out free checks. And we said that the problem would start actually for the economy and the markets when the pandemic was over. Now, again, I'm not suggesting that COVID is over, but it feels like it's over. The economy's decided we're going to move on. Well, except China, but the rest of the world has decided they're going to move on. So money was printed, and all of a sudden, when you get back to normal, you've got all this too much money sloshing around, and the prices of things started going up. Historically, when the US Federal Reserve says the economy is creating too much demand and prices are going up, the tool that they have to cool that demand is by raising interest rates. And as regular clients would know, and we've been watching this for 36 years, every recession is preceded by something called an inverted yield curve. Now, not all inverted yield curves lead to recession, but every recession is preceded, including, by the way, slight inversion in late 2019 in the 2020 pandemic recession, which is quite curious. But in a normal economic environment, you have an economic cycle of boom, and I hate to say bust. Now, what is a yield curve? A yield curve is a picture of interest rates. So here we have the United States yield curve, and we have a picture of interest rates. So we can see down here on the bottom left, a year ago, or 6 months ago, US interest rates were still very, very close to zero, about 0.1 if you bought a US Treasury bill. And people knew that that wasn't sustainable. So 6 months ago, say a 5-year bond was about 2.5, and a 10-year bond was about 2.5. And you can see a month ago, rates were much higher, and then they're higher yet again today. An inversion of the curve happens when the short-term interest rates go above the long-term interest rates. Now this creates a situation where cash becomes the greatest yield available. And when cash becomes the greatest yield, money stops working in the economy. People just start parking their money on the sidelines. So the true yield curve actually measures the cash rate out to about the 5 or 10-year bond. And you can see in the United States, cash is paying about 2.5%, which is actually far lower than the 5-year and the 10-year bond, which are yielding just under 4% today in the United States. So the yield curve is nowhere close to being inverted. But here's why people are calling for recession. If you look at the 2-year bond is reflective of the market, and they're trying to anticipate where rates are going. So the 2-year bond is trading slightly over 4% as well. And Jerome Powell, who sets US interest rates, has given us strong indications that they're going to keep raising rates north of 4%. And so the people look at the 2-year to 10-year and they say, ah, that's inverted. And the 2-year just says that the curve will be inverted by the new year of 2023. And so we're not there yet. And the data is not there in terms of US recession, but we're looking at a 2023 slowdown of some kind. Now, this is the Government of Canada yield curve, which points a picture that already is suggesting that we're seeing a slowdown. And I'm going to talk about this later, and I've talked about it in my June call. We're seeing a dramatic turnaround in Canada's most important industry, which is the housing industry. It's an incredible statistic, but 1 in 50 people in Toronto are realtors. That is the highest in North America by a mile. Just to put it in perspective, it's about 1 in 200 in Los Angeles. So, I mean, these people's income have dropped dramatically as house sales have slowed. But you can see that the yield curve is very, very flat. A Treasury bill pays 3.3%, a 5-year bond pays 3.3%. So that's flat, which is suggestive of a no growth economy. The Bank of Canada signaled that they're not done raising rates. And so if you look at the 2-year Government of Canada, we're looking at 4%, which is steep, getting to be steeply inverted. We're seeing a bit of a different picture in Canada and the United States, which is suggesting that the slowdown is going to be more severe in Canada than the United States. And look at that yield from 6 months ago. I mean, this is dramatic. The rates moves that we've seen in the last 6 months from, I mean, they're Canada below 0.5% on its way to 4%. Now, we're going to talk about something which is every recession is preceded by an inverted yield curve, but not all yield curve inversions lead to recession. So there are exceptions, not many, but if you think about the mid-90s, rates started going up. 1987, rates going up. 87, the market crashed, but the market was wrong. You actually need two things. Two things you need to get a recession. So this is New York City gas prices, courtesy of just my app, printed it off, GasBuddy, which I use to make sure I'm paying the lowest price I can. New York City gas prices, this year rates have been going up, but gas prices have been falling. Yeah, New York City gas prices in February were $5.50, and they're down to $3.25. Just to put this in perspective for Canadians, at 3.78 liters, that's 85 cents. Now, I know in Canada it might be $1.20 something, but 85 cents, they earn US dollars. And so gas has gone pretty cheap in the United States. So again, you've got these two things. We're missing one to get the full recession call. I took this 2 days ago on my way home because I thought there was a mistake, and I had to do a double take. Like, oh, the SO station put a 2 in front instead of, it's a wrong number. Well, that was just North Vancouver at Westmount, and sorry, click down. I checked my GasBuddy app, and sure enough, that's the price. In fact, I looked today, and we're at 233.9. They've gone even higher. So in Canada, you've got rising rates and rising gas prices. Now, I know this is a BC phenomenon. I know we have, but you know, we're not feeling the same effect of the lower gas prices because of a lot of taxes and carbon taxes and everything. Government, you can't have your cake and eat it too. It's still a very important part of the economy, and if people's mortgages are going up and at the same time their lines of credit and they're paying, you know, these kind of prices to fill up mom's car in the Ford Escape is going to be $140. That's That's going to be tough on the economy for sure. So we're talking about higher rates, and we talked about money supply, and we suggested that interest rates would have to go up to combat inflation. But an interesting thing's happening is gas prices have come down, and West Texas was 104, 125 recently, and we're 80 today. So that's come down. Now, is it just oil? Well, I see lumber prices today hit their low for the year, and we were saying, oh, there's so much demand, lumber is going through the roof. Well, fortunately, if you're building a house, good news, your framing costs just went down dramatically. So this is a chart of the Commodity Research Bureau. So there's an index for commodities, just like there's an index for stocks. We can call the S&P 500, we can call the Dow. This is the commodity index. So it measures not just gas, but copper, natural gas, things that we use in our everyday lives. And you can see that we're back to February levels, but they've stopped going up. And they've declined from their April, May peak. And we're not seeing any more inflation on that front. We've got 6 months of no commodity increases. Now, if you watch my call, we talked about the money supply going up, and look at that spike. I've shown you different ways. Last time I showed you the actual U.S. Federal Reserve chart, but this is thanks Tony Dwyer from Canaccord Genuity in New York, got us some great slides. But this is money supply. Look at that dramatic increase. So we're going back to the 40s, and look at the dramatic increase in the money supply. And again, I watched the month of the market bottom, and Jerome Powell's on 60 Minutes. He goes, well, we're printing money. And the interviewer said, isn't that going to lead to inflation? He said, well, we'll deal with that later. So the money supply is now down to a 0 growth rate. And that's good news. Now, again, there's a lag. There is a lag, but the money printing will lead to inflation. Not money printing will not lead to inflation. In fact, you need money supply growth of about 4% just to keep prices even, because if the population grows at 2%, you need 2% more money to distribute within the economy. And if productivity is growing, then you can grow the economy. So you need 4% just to have a 0 inflation rate. So that's the good news. Now, it's possible we're still dealing with the massive spike in the money supply, but eventually we're going to see inflation start to roll down. I'm going to go back this for a second, just a conversation I had with a client last week. And he's talking about inflation. He said, I'm just going to visit his daughter in Southern California who lives there, and he's a grandfather. So he makes regular trips. And he said, the hotel I stay at last year was $250 a night, and now it's $500. Yes, that's dramatic inflation. But where do we go from here? Is it inflation that's recurring? Is it going to go 500, 600, 700, 800? Or is it maybe staying at 500? In other words, we saw this immediate spike in prices, and maybe it stays at 500. Maybe it actually starts to roll down if the economy slows down. So, okay, so we're starting to see the money supply roll down. We're starting to see commodities not inflating anymore. There's one missing piece of the puzzle to get interest rates to stop going up. And this is yesterday's news. Jobless claims hit a 5-month low despite Fed's effort to slow the labor market. We spelled labor wrong if you're an American, but that's okay. We'll accept their spelling. So the last piece of the missing puzzle is that we still have a labor shortage, and wages are growing. And if if everybody gets a 5% raise, the prices of everything's going up 5. Nobody's ahead. I was playing tennis with one of friend and a client of ours, and he's involved in the BC construction industry. There's a pending strike amongst the unionized construction workers in British Columbia. They want to have 12% per annum increases plus COLA, which is cost of living increases. And as long as you get this kind of recurring, everybody wants more money, then we're still into the 70s. So, okay, so we mentioned that interest rates are not going to go to the sky because we're starting to see the positives of inflation not continuing to spike and roll down. But let's also be clear that it's a tough battle to bring inflation down. So what we're seeing is when you have inflation above 5%, how many years did it take to get back to 2? You know, everybody's talking, we're going to go back to 2. Well, the average was 10 years. And, you know, so don't think, you know, Canada, look, you know, last time it went over 5 was, what is that, 12 years to get down. So I was watching BNN a month ago, and somebody was talking about real estate and not to worry because, you know, when rates went down next year, and the reality is that it's highly unlikely that we're going to see a 0 interest rates and mortgages back below 2 again for maybe ever. Okay, so rates going up, the economy slows. Let's talk about, this is a chart from last week, so last month's conversations. I'm just going to reiterate it because I think it's important. The S&P is down 24% from its peak. So if we look at previous recessions, you see 09. I mean, my God, we got to go down another 20. But wait a minute, 09 was an outlier. Banks were failing. Look at 73. Look at 80. I mean, 73 were there already. 81, 90, 2001. You know, the market's gone down more than those recessions. So it's highly probable that when you hear the word recession, instead of thinking of selling and liquidating my portfolio, think about, Dave, where are there opportunities? Again, thanks, Tony Dwyer, excellent chart here. So if we take all the recessions going back since the 50s, where are we now? And when you hear of recession talk, you can see this is before the recession. The markets start declining well before, in fact, the economy starts to slow. Markets are very good at that. But you can see sometimes the black line shows you that, you know, whether it's black or blue, when you're talking about recession, the markets are going to do the same thing. Going to be down, you know, 20%. Let's remember, the market's not always right. 2018, the market was down 20%. We were going to go into a recession led by Trump's trade war. When you don't have a recession, here's where we are today in terms of timeline. Here's where we are. So the market either meanders and on average only has 2 or 3% more of downside, or we don't have a recession and the market actually rips higher. We look at this is an excellent entry point. I'm going to talk about another thing that's happening. That's the 4-year presidential cycle. We are in the 2nd year of a presidential term. Now, if you watch my November and my December, my January calls, I talk about this is going to be a difficult year in the markets. Well, why did I know that? What's the 2nd year of a presidential term? So the first year is that, you know, was last year. Joe Biden's the new president. Then you got the midterm elections. That's the 2nd year. First year, we'll call it the honeymoon year. Markets do pretty well. 2nd year, by the way, since 1950, the total returns in the 2nd year of a presidential term are close to 0. But the third year is the best year. Now, but within the 2nd year, so the worst year of the 4 years is the 2nd year. This is when we're in. The worst month is September. And the worst week is the one we're in right now. But the good news is, it's not that exact, but the good news is in election years, the markets bottom sometime between the middle of September and the 3rd week of October. So it's highly possible that we actually go into look where we are today. It's not that, I mean, it's below the blue line of the typical midterm cycle. And the Fed's raising rates faster than they normally do. But why is the second year such a bad year? Well, the second year is typically when the US Fed raises rates. They don't typically do it in the presidential election years. And they typically get the tough medicine done in the middle of a term. Rising rates are typically not favorable for stocks. People are pulling money out into the rising rate environment. They're putting their money in other assets, risk-free assets. Rates go from 0 to 4. Somebody's going to bail. Someone's going to say, I'm out. I want to put it in guaranteed. So here we are in the midterms, and you can see, you know, we had 5 people call this week and say, I want to go to cash. Fortunately, none of them did. But this is reminiscent. People talked about the June, and they said, we're not at the bottom because we haven't seen the panic. And I had nobody call in June. We're back to where we were in June, and I had no panic. Now I'm getting panic. And that's good news, because I know some of these are the same people that got very, very worried in the COVID bottom and let's go to cash, or the 2018 bottom. And so when your gut people, when your gut says this, I can't take it anymore, this is probably, you're getting probably pretty close to a bottom. So of the 208 possible weeks of a 4-year economic term, historically, today's the day to buy. Historically, by the way, which is one of the reasons I did this call on a Friday, because I wanted to make today is historically the best day to buy. Now, the best week, best month, best year to buy on a 4-year presidential cycle. So we look at these recessionary fears. Now, again, unanimous consensus of a recession, and you know, one of the things that we look at is when you get extremes of sentiment. And we've talked about this before, but here we are, sentiment amongst, there's a weekly survey called the American Association of Individual Investors. And the sentiment numbers are near their extreme lows of all time. In other words, if everyone who has the propensity to get in and out has gotten out, there's no more sellers left. So at extremes, you can see here 2000 when the tech wreck. You can see here the 2000, although that's the 09. There is the bottom after the technology, 2 years of declines. You can see the pandemic was right here. It's incredible, but we're more negative today than the pandemic bottom, which is quite amazing. So that in itself gives you a buying indicator that there's too much extreme. This is an incredible statistics. Put option volume jumps to record high. I don't want to get overly technical here, but a put option is a speculation of a declining stock price. And people may be hedging, they may be speculating. A put is the right but not the obligation to sell stock at a predetermined price. So at the end of the day, if you think the S&P 500 is going from 3,800 to 3,000, you might buy a put option that would only benefit on a market decline of some magnitude. So when you see that the people that were buying crypto and they were buying tech stocks and meme stocks, that they all sort of gathered together and bought these ridiculous overpriced stocks a few years ago, this group has now found the new path to riches: speculate on a market decline. When you see that at a record, it's probably safe to say that these people when you see a group en masse, groups of mass thinking are rarely right, if ever. And so when you see en masse the highest amount of speculation on lower stock prices, it's time to start looking around and sniffing for where to put your money. So we're at the lowest point in the cycle. We have very negative sentiment, and we have speculators now betting on market declines. So let me talk further here. And again, I'm talking too long. U.S. government bond. Fortunately, we looked at the money supply. We said rates are going up. The worst place to be. It's the worst year for bonds in history. The good news is we do not own any bonds. So U.S. This is TLT. It's one of the biggest, if not the biggest, U.S. government bond exchange traded fund, minus 30 year to date. We're not there. Good news. The other place that's affected by rates is large cap. We talked about this last year. Avoid bonds, avoid large cap technology. Here are the biggest 8 companies in the United States. Our exposure is 0 to very low on this exposure, minus 34 on average for these mega companies. They're wonderful companies, but they got overpriced. When rates are going up, people are paying for growth in the future. You discount that at a higher interest rate, it depresses the price of that. I don't want to get that too much. Now, I got to cover some technical stuff here. Talked about preferred shares. I want to show you in here what happens when there's a little panic going on. BCE showing 1770. I want to show you the bid and ask spread. So if you volume 0, if you go log in online, what's the price? Well, we're going to use a conservative number. So we're going to say, well, if you have to sell, it's 1770. So that's the price you're going to see if you log in at the end of the day or at some point in the midday. Well, that's a big spread. Is it $19? Is it $17.70? That's the price you're going to see. So if you are one of these people that sort of logs in multiple times or every day, I would say don't sell that day. I've got a chart of BCE, and if you look, we didn't buy a single share in at the peak of $21, but technically, if you're just valuing your businesses day to day, you're going to say I'm down, even though you might have bought it over here or even here. Now, if you bought it here, you break even. But I want to talk about what's happened at the BCEB. So when we were buying it over here and even here, the dividend is based on the prime lending rate. So it's $25 of preferred. Based on that, they do a math, and the dividend was 63 cents. Guess what? Prime's been going up and up and up. Now the dividend is 132. And it's not done because that was mid-September. So the next dividend is 136. The Bank of Canada has told the markets they're going to raise again, which will put the dividend at 148. If we're going to just look at stocks and value our accounts on a day-to-day basis, it's tough owning these preferreds because just from bid and ask, they can move 5%. If someone panics and buys it tomorrow, it's going to move up 7%. So if you're inclined to worry about that stuff, but in 5 years, we're going to make almost $7.50 of dividends on a $17 stock. Now, I doubt seriously that the shares will stay down here because the dividend from here to here, share price has not changed. The dividend has more than doubled. It's almost a triple of your dividend. If the Bank of Canada raises one more time, this is Bell Canada, incorporated in 1851. It's seen many, many economic cycles. I'm not worried about it in an economic cycle. But here we are. And just think about I was talking to a client 2 days ago. He goes, yeah, but the dividends are so good. Like he doesn't look at his account in terms of, he says, my God, that's fantastic cash flow. Yields on preferreds are the highest level we've seen since 1992. This is not something that I want to liquidate. Enbridge B, we own a lot of this. It's great. I've mentioned it on the calls before. Okay, it dropped to $17.50, but the dividend was just raised from 80 cents to $1.30. $1.30 of dividends. We're going to make close to $7 in dividends, again, on a 17 handle. Enbridge is the toll master of moving oil and gas around. Environmentalists say we can't build anymore, so we're just going to sit on our tolls and collect fees. It's a great way to collect dividends. And let's remember, preferred shares rank ahead of the common. The Enbridge common stock is one of the biggest companies in Canada with a market valuation of more than $100 billion. Preferreds rank ahead of that. So it ranks safer than any of those common shareholders. Are we going to lose the money in there? No. Okay, so let's talk about, just for a moment, the recession in Canada. United States, there's going to be a slowdown in the United States because the US Fed is targeting not necessarily inflation, they're targeting employment. So by definition, he wants to get the shortage of labor. He wants to create a slowdown. But he doesn't need to get unemployment to 10% like we're used to in recessionary times. They're just going to put the brakes on to a point where we're going to start to see some layoffs. They got to get unemployment back to 4 to 4.5% before wages don't, stop going up and up and up. So the United States, highly probable that we're going to see a zero, some kind of a slowdown recession. I know Canada, yes, recession, because we have a difference. And the difference in the Canadian US economy is in the United States, when rates go up, the conventional mortgage, of which 93% of people have in the United States, is a fixed mortgage. 70% of people have a mortgage in Canada and the United States, but you're fixed. And if you locked in last year, everyone did, as rates came down, they lock in as rates go down. So they have a 3% mortgage. The US Fed raises rates, honey, we're not moving, staying where we are, just going to keep our 3% mortgage. But in Canada, we have floating rate mortgages, or we even if everyone on the planet had 5-year mortgages, you'd have more than 1% coming due every month. So with floating and fixed, we've got a problem, which is 2 to 3% of mortgages come due every single month. And I want to relay a story we had with one of our team members at LePoidevin Group, and her friend called and said, "Oh my God, my mortgage has come due." And it was below 2%, and it was $1.5 million. Now, $1.5 million is what everybody has in Vancouver and Toronto, because prices are insane. They were insane because they kept pushing, we've got a housing problem and it's undersupply. Well, government kept pushing rates down, encouraging people to borrow. The principal reason we have such high house prices is because people are borrowing an insane amount of money. So one of our team members called, and her friend's mortgage was up for renewal, $1.5 million mortgage, and it was below 2. And the mortgage rate is going to go from $6,076 a month to $10,100. There is going to be some level of the population that can't make that happen. We know the stats from Equifax, about 2% of Canadians who live within 200. They can't go 4,000 a month over. I remember that loan losses in Canada have been around 0.15 for the better part of 20 years. And look, if you couldn't make your payments on your house, you could sell it for a profit. This is just from Realty Link. It's a great site, all of British Columbia. But East Vancouver, I mean, these are houses most of them I wouldn't rent if I was 21 years old and living with my, buddies. But 2.2, I mean, these are 3,700 square foot lots with 1,700 square foot houses that were built in World War II era. And, with 3,000,015,15. I mean, these are mortgages that people are going to be looking at $10,000 a month on. And it's just, it can't work. I mean, these houses in the United States would be, even today, would probably be 200 or 300,000. So there's a lot of downside, and people aren't paying attention to what's happening. Again, I put this on the last slide. I'll go over it quick. Like you guys can read it. This is the checklist for what's coming. Be careful. I put a list here of GICs. I'm getting a lot of calls from clients who saying, hey, why don't we just buy some GICs? And I go, well, first of all, number one, this is just high to low in interest rates. Home bank, well, that's equitable. Home capital almost went bankrupt a few years ago. There's a high chance that they don't make it through this housing decline. I mean, there's so many names here that I'd never heard of. You look at home equity, that's home capital as well. You look at equitable. There are names here that are not going to exist. So do not go above deposit insurance. I would hesitate even putting any money in these, because you're going to be you will get your money back if you go deposit insurance. I've said avoid credit union insurance. Absolutely. If you've got your money in a mortgage fund, get out. The other thing I will talk about just quickly is if you're going to say, hey, let's just get a 5-year GIC at 4.7 or 6. Well, wait a minute. I just said Bell Canada is going to pay 7.5 in dividends. So we'll be up 45% in dividends alone. And that doesn't even assume any share price appreciation. I'd be highly surprised if they don't start going up. Look, Bell Canada pays prime lending rate. We're buying them at a discount, so they pay 140% of prime. Prime lending rate, lending. Trust companies, even if they're high risk, can't pay you more than prime. So we can buy a GIC at 80% of prime, or we can buy Bell Canada 140% of prime. And the Bell Canada will be tax advantaged if you buy it because it's a Canadian dividend. So once again, I've gone way over my time. But that's where we have it. I can't believe the bargains out there. When you hear the word recession, be careful, because there are some consequences. We've talked about avoid Canadian credit exposure, but in Canada, the resource companies, the global industrials are going to fare just fine. In the United States, I'm not there on the U.S. style, 2009 recession. There is no subprime market in the United States. They don't exist. As we know, we did buy for some clients some put options on Countrywide and Washington Mutual. They went bankrupt. These companies don't exist anymore. There's just conventional, tough to get a loan mortgages. Unfortunately, Canada's subprime industry has now exceeded the United States in terms of its size and magnitude than the US did in 2007. So be careful, it's coming. But the United States did very poorly in 2009. Canada fared very well because we had almost no subprime. Now we have a thriving subprime and they don't. So Canada's going to take it on the chin on this slowdown, and the US will get through with a mild slowdown. I'm trying to answer a lot of questions that came in. I'm going to let Marc handle. We had a few people asking about currency because we're seeing a lot of movement. I'm going to throw it over to Marc to go through the currency, and we'll go from there. Marc, do I have to hit something here?
Okay, so can you see the screen share? Yeah. Okay, great. So I don't think there's a lot of people out there excited about talking about currencies, but given what's going on, I'm happy to do it. So let's start with this 3-year US dollar index chart. So US dollar index is comparing the US dollar against a basket of other currencies: Canadian dollar, Swiss franc. You've got US dollar, yen, and pound, or sorry, yen, pound, and euro make up about 80% of that basket. So you can see right around here is the point where the US Fed capitulated on the idea of transitory inflation, and it's been, the US dollar has been effectively like a rocket ship against a basket of every other currency since then. So you can see the Canadian dollar has weakened considerably, the Japanese yen has weakened considerably, the euro, and then we've got the pound recently with the Prime Minister instituting a whole bunch of tax cuts and higher debt. So from the perspective of implications on why that's happening. We've got really strong US dollar, and we've got implications from that. So from the positive perspective, you've got cheaper imports from the US perspective. So that's actually going to reduce inflationary pressures. So that's one thing we can put on the positive side of the ledger. The negatives are being felt by other nations around the world. So consider that most international trade is being done in US dollars. That's getting more expensive. We're seeing US denominated debt held by other nations. That's getting more expensive for them. Commodity prices in US dollars are getting more expensive. And we're experiencing tighter credit conditions in a lot of places. So, historically, consider Latin America through the 70s loaded up on US denominated debt all through the 70s, which was fine until Volcker took rates way up, and we saw lots of defaults, and that led to the lost decade. Just earlier this year, Sri Lanka importing food got more expensive, US denominated debt got more expensive, energy prices in US dollars got more expensive, and they defaulted for the first time. So you've got some positives to the US from the perspective of their higher dollar, but a lot of negative impacts for other places around the world. So if you are a weak currency, you need to defend that, and you defend that by maintaining higher rates. You protect against capital outflows and the inflationary pressures that come with that weakening dollar. If you're the US and you've got the strong dollar, you've got more flexibility with that. So if your base case from a Canadian perspective is that the Bank of Canada is going to lead all other central banks to lower rates, you also have to consider what that's going to do to the Canadian dollar and the inflationary pressures that would come with that, which is exactly what they're trying to stop right now. So really interesting stuff on the currency side of things. That's it.
Hey guys, thanks. I'm just going to go through one more thing, and that is Mark and I had an idea of just every once in a while throwing out some educational, so it wouldn't be a conference call, but we might just start sending you some clips on, just topics of state issues, dividend issues, tax issues. So that's kind of our idea. And as you know, we've got team members, Darcy Crow, and she's awesome on sort of high level, complicated family situations. And Fletcher in our Toronto office can talk about some topics. So we've got Ann Jackson on the planning side. So let me know what you think about that idea. If anyone's still on this call, send me an email if you like the idea of doing some education. You tune in, tune out to the topics you're interested in. But we still plan on coming regularly from the market about what's going on currently, but give you some high level other topics too. So let me know what you think about that. And thanks everyone. And hopefully we've made some money between now and the next time we talk. Thanks.